Hello, everyone. Thank you again for attending our Zoll Agency's after lunch learning sessions, I would say. And I think we started this last year after the tax season, and we focus a lot on why real estate investment is a great tax strategy or why it is the best investment under the current tax code. Today, we're going to take a little bit of a detour for a lot of reasons. We're going to talk a little about the how permanent life insurance is also a tax strategy and how we can maximize the tax efficiency. Most of you are my clients, so you know who I am. I don't want to say too much about who I am, wasting everyone's breath. I do want to introduce my good friend, my great advisor, and also a client of mine, Bruce. So, Bruce, it's all you.
Okay, well, nice to meet everybody. As you can see, that's a better picture of me than I am now. But I've been a brokerage general agent for the last 40 years. I work with agents to help them present to their clients tax-efficient planning strategies focusing on insurance. So I come back at this from a very technical perspective and can assist you in figuring out what's the best option for your clients.
Yeah, I always say Bruce is the best engineer in this industry.
Yeah, you call me a walking encyclopedia.
Yeah, also walking encyclopedia. Yeah, you helped me and helped a lot of my clients to design some great plans for their family. So thank you. And thank you for spending the time with us today. So the next one, just a little bit of a spiel of our company. People would always say you are CPA, why you're dabbing into so many different things. So we don't just position ourselves as a CPA firm. Yes, we are, but we're not only a CPA firm. We're trying to implement, and execute sometimes even tax efficient wealth accumulation protection strategy solutions for our clients. And somehow due to COVID, Bruce, now my clients all over the country. I mean, actually, it's all over the world. So that's a really cool thing. Through remote meeting like this. I used to do a lot of seminars in person, but webinars are much more far-reaching. And we do have, under the Zoll Agency umbrella, we do have the accounting, the core, the insurance, and the real estate. And they are all very important part of our operation to help our clients to have kind of a all-around service. So let's go right into the subject, right? Why is life insurance a tax strategy? Isn't life insurance a protection for the family? Something happened when, to me, my kids will have a comfortable life. That's what most people's concept of life insurance. But everyone forgets one very simple fact is the death benefit itself is income tax free. So let's say if you leave a 401k to your kids, when they get it, because you haven't paid tax, they all have to pay tax when they take it out. But when something happened to me, my kids get the death benefit, it's tax free. And from this webinar, you will learn if we design a life insurance, a permanent life insurance in the right way, we can encourage, or not just encourage, it can happen, we can execute tax-deferred, even tax-free growth. And we can take distributions tax-deferred, and if you design them correctly, it's also tax-free. Sounds too good to be true. We will get to there. And the last point on the tax strategy is a very, very important tool in estate planning. Bruce, you have anything to chime in here?
No, you've covered the main 4 points. I think, we go to the next couple slides, we'll get into details on all of these points.
Yes. Okay. Without further ado, the first thing I want to talk about is giving you a lot of numbers. So to show you, the death benefit is income tax free. So Bruce prepared this really nice illustration for us to show you how term life insurance is affordable, how affordable it is for a family.
Right. And we're trying to compare and contrast term insurance versus permanent insurance.
Yes.
Term insurance also enjoys income tax-free death benefit and potentially can be used in estate purposes. But term insurance is in this case, we have a 35-year-old, it's less than pennies on the dollar. This is a pure durational play to generally protect income or business purposes. But this is a pure expense. Unless you die, and we hope none of you die, but everybody's going to go away sometime. But unless you die, you get nothing back for term insurance. So one must think of it as pure protection, pure expense, no investment return, no other positives out of it.
Yes, I just want to make a case here. Look at it. First of all, now we have 40-year term, which is really great. I remember I was 27 when I bought my 20-year term, and I paid only $30 a month. Those are great dollars spent to protect your family. If you look at this, it's even a 30-year, it's only $700 a month, right?
A year.
A year. I'm sorry, $738 a year. Yeah, so it's about $60
or $1 million.
Yeah. So we just
there's a reason for it.
Yeah.
They're never going to make a claim. 35-year-olds, the odds of a 35-year-old dying before age 65 are slim to none. Well, look at the jump when you get to a 40-year-old. Now you're a 40-year term. Now you're talking age 75.
The earlier you buy, the better, right?
Yeah. Mm-hmm. Well, also, you can start talking about the mortality curve between a 65-year-old and a 75-year-old, and you're twice as likely to die.
Yeah. And always the joke is always people when they reach out to me. I recently have a 73-year-old reach out to me, want some kind of term life insurance, and it's impossible, right? So the point here is the death benefit is still income tax free, which is great. That's the tax perspective, but this policy is really a great protection for your family. And I just want everyone to know it's really affordable, and there's a great product out there to protect your family, especially you have younger children, right? It's, and you are the sole bread earner or whatever the situation it is. Okay.
Yeah. With many of your clients, we see this as part of a blend. Most of your clients are very good at understanding when we talk about the investment opportunity on permanent. But this is, we'll talk about blends later, but this is to really focus on income protection.
Yes. And here comes the point that Bruce made, because we're going to segue into the permanent life insurance. That's where we can design it to maximize the tax efficiency. So you want to give it another elevator speech of what's the difference between term and perm?
Well, term insurance, we saw it. There's no cash value. It's death benefit only. Typically, it's a durational term. And after you're done with that duration, whether it be 10, 20, 30, 40 years, you're done. You can't do anything with the policy. You have to reapply to a company if you want to extend it at an older age, which is much more expensive. That 35-year-old at age 65, instead of being $700, is going to be closer to $10,000 if he ends up wanting more insurance at that point. So it is very specifically a durational term product. Permanent it's a very wide array of products that we have from the permanent marketplace, but it's meant to be there for life.
Yes, that's it. Permanent. It should be there. The joke is it should be there when I die, right?
Otherwise, I always joke, tell me when you're going to die, I'll tell you the right product to buy. But if you tell me when you're going to die, I can't tell you the right product.
We are going to focus more on the permanent. But first, I want to touch upon the second thing we talk about. If you design your life insurance, permanent life insurance correctly, you will achieve tax-deferred and even tax-free growth. And how do we do that? First, let's look at the tax code. I like to wear my CPA hat, right? In the Internal Revenue Code 7702, Section 7702, defines there's a criteria for life insurance contract to qualify for favorable tax treatment. And that's where we say that we can make all your growth in your life insurance policy tax deferred. And if you design it correctly in the distribution period, then it will be tax free. I would really like Bruce, because Bruce is older than me, has more historical perspective of this 7702, right? So tell us what's going on here.
Okay. 7702 came out in 1984. Obviously, permanent insurance has been around much longer than 1984. What happened back then was, frankly, the computer revolution. Actuaries were able to unpack traditional life insurance and came up with a product called universal life insurance, because they can get into, at the time it was Lotus 123, and now we talk about Excel spreadsheets, but large spreadsheet programs. One company, an investment company back in 1978 called E.F. Hutton, looked at life insurance and said, this is actually a very strong chassis for investment purposes. So they actually created the first, it wasn't a life insurance company, it was an investment company that created Universal Life. They actually had a T-bill indexed universal life policy. What they did is they went to all their clients that had T-bill, treasury bill portfolios and said, how would you like to make the growth of this portfolio tax deferred? How would you like to make the growth of this portfolio upon your death income tax free? And how would you like to get tax deferred or tax free income out of it? It was revolutionary.
Yeah, T-bill has very high yield in the 80s, right?
Yeah, T-bills in they ran all the way up in 13 to 18%.
Yeah, I remember they were double digit. So in a way, if you imagine in the 80s, right, T-bills double digit income, and someone so smart to put this wrapped around in the life insurance policy, because life insurance has this preferable tax treatment from a tax code standpoint of view. They're very smart. They put it in that package, so all your investment will grow tax deferred or tax free, right? So what happened then? The IRS comes in, right? The IRS always, this is too good to be true.
The IRS giveth and the IRS taketh away.
Yeah, that's a good way to put it.
And I represented that company. I'm old enough to represent them at one point. And they would have on $100,000 only maybe $150,000 of death benefit. The mortality charges, all the expenses were much, much lower than the taxes that would have normally been paid. This is a great win for their policy.
So this is, again, you have a tax code, some smart people just trying to make the best out of it. I wouldn't say they're bad. So, but IRS is also smart. And 4 years later, they came up with something called modified endowment contract.
Right.
So basically, they, just like Bruce said, they give you some and then take them back. So basically, they are saying that for a life insurance to qualify for that preferable treatment, which is talking about the 7702, there are a lot of tests you have to meet to make sure that the tax advantages cannot exceed the premium limits. It's very complicated. So that is why they say, hey, there's a good thing come up here. I'm going to cap the good thing. You cannot make it too good, right, Bruce?
Right. The IRS was losing literally billions of dollars. Back in the 80s, that's a lot of money. But they were losing billions of dollars every year in tax income, revenue, I should say. Because of these products. And life insurance enjoys these benefits because of the social good that it does. It's encouraged by Congress. It's encouraged by the Senate. We have tax code that encourages people to buy life insurance because it's important. It's important to take care of your family. But it's too much of a good thing.
Yes.
So what they did is they limited the amount that we could put in. I can no longer put in $100,000 single pay on a $150,000 policy. And I think your next slide talks about I'm going to have Bruce talk about now, if we have something called a MAC. So if you somehow bought a life insurance that's MAC'd, that would be terrible, because you're buying, especially if you're buying it for tax purposes, to have tax deferred, tax free income, then you will really walk into a bomb, right? Because it's not going to help you. So how do we not MAC the policy? Well, real quick first, and what the main change is with MEC. MEC, you still get tax deferred growth.
MEC, when you take out the money.
Yeah, MEC, you still have income tax free death benefit. MEC, the problem is when you take money out, you go from first in, first out to last in, first out. They tax every dollar coming out immediately. If you're under age 59 and a half, when you pull money out, you get another 10% federal income tax penalty. So they let most of it.
They basically tax the gain first.
Yeah.
Yeah.
Yeah,
it's the worst kind of tax treatment.
Yeah. So that's the big deal with why we want to avoid MEC for almost all of our cases.
Especially if you are buying it to use it as a tax strategy for tax deferred and tax free. The reason I keep saying that tax deferred and tax free is because technically it is tax deferred, but if you use it correctly, design it correctly, it will achieve tax free. But it's not just naturally or automatically tax free, right, Bruce? Mm-hmm. Okay. Now let's talk about some very technical stuff with the engineer of the life insurance policy, Bruce, talking about how do we not MAC a policy.
Okay, so the IRS came up with two more acts, DEFRA and TAMRA, which you don't need to know what they are, but they came up with multiple tests to verify that a policy can enjoy non-MEC status. The first one is a cash value accumulation test. We call it CVAT. The cash value accumulation test basically is a corridor of the amount of cash in a policy versus the death benefit at an age that you cannot exceed. Again, too much of a good thing. The other one, which is actually more common with most products, is guideline premium test, or the guideline premium and corridor test. We call it GPT. And that limits the amount of premium that we can put into the policy. And there's other formulas that you really don't need to know as a user that go into how much can go in there. Our software, or the company's software, automatically tests for all this. Most products are either built as a GPT or built as a CVAT. Some contracts allow you to choose, but you have to choose it at issue, and it's an irrevocable choice. So behind the scenes, you're dealing with products that are complying with one of these two codes, and we work very hard to avoid MEC almost in all cases. Yes. Once you trigger MEC, it is also irrevocable. You have 1 year, the company can work with you, and the year you do it, you have 1 year to back the monies out, make it back in compliance. But once you trigger it, it is forever a MEC. You can never undo it.
Yeah. The reason we're going so detailed is almost like a life insurance agent training course here, is not to bore all of you. I really like to talk about life insurance from a tax standpoint of view. That is why I'm talking about the tax code, talking about this MAC. So basically, it is an investment product that's wrapped in the life insurance with a lot of regulations. So that is also why most of my clients, and Bruce, you can attest to that, we max fund the policy, my own policy too. What do you mean by max fund? Max fund means it's $1 shy of MAC. Mm-hmm. So there's a good thing the government tell you, but give you, and then they take away. So you cannot go all the way up. You only can go here. So what we do is we go right under that. Mm-hmm. That is also why I saw a lot of people, my clients were sending me the policies they purchased somewhere else, and these policies were underfunded. Yep. So we're talking about max funded is right under MAC, and then underfunded is even under the target, right? It's just kind of minimum funding, which they think they got a good deal. They got the worst deal. It's almost like you have a 7,000 Roth IRA contribution this year. You say, I'm not spending $7,000. I'm only spending $700. Look how smart I am. If I put it this way, everyone understands, no, I want to do 7,000 because it's a good thing, right? But when it comes to permanent life insurance, a lot of people are getting swayed by these wrong concepts. You have to max fund your permanent life insurance. And if you don't have enough budget to max fund let's say a $2 million policy, we always do the blend, which you can do a $500,000 permanent and supplement with a $1.5 million of what? Term. So you will meet your budget constraint. It does what both policies will do exactly what you intend them to do. That is why I always say in a life insurance policy, the most important component is the advisor. The insurance company is definitely important. The product is important, but it's for the advisor to know what you're trying to achieve with these life insurance policies. Very sadly, that 90% of the policies I review are designed wrong. And that is why the urgency of doing this webinar, to make sure my clients all understand these are very important things. And there is a book, I'm sure you know, Bruce, it's called Look Before You Lerp.
Okay, I've heard
Yeah,
of it.
yeah. So basically, they said to buy a life insurance policy, a permanent life insurance policy, is almost like a marriage. You have to make sure you really understand what you're buying, right?
Right.
Anyways, I think we have an example Bruce prepared
Yeah,
for us,
and
right?
you know what?
Yeah,
To your
yeah.
point of the underfunded policies, where I
Uh-huh.
tend to see that are when people look at life insurance as an expense
Uh-huh.
instead of an investment.
Mm-hmm.
If you think of it as an expense, you want to get the cheapest dollar in you possibly can.
And that's term.
And that's term, and I see it under some permanent policies too. But when you start looking at it as this is part of my portfolio,
Mm-hmm.
funding and performance changes dramatically. And
Yes.
the stability of the product also changes dramatically because when you really thin fund these policies,
Mm-hmm.
if we have down years in the market, lower returns, these policies are the ones that are most adversely
Mm-hmm.
affected by downward market swings. Okay,
Right.
now
You're right.
you talked
No,
about
no,
what.
you really had a good point. Like it's these two different term and perm, they serve kind of different purposes. And you
Yep,
cannot take the wrong approach to use the wrong criteria, right? So
right.
for permanent life insurance, I want to stress here, you need to max fund it. If you walk away from this webinar, that's what you learned, I'm happy. So this is where Bruce did a max funded um, policy illustration, right? Go ahead, Bruce.
Okay, so there's no magic here. We took our same 35-year-old. Justine basically said, "Let's go with $1 million." So that's where we drove everything. You see all that little tiny font? I don't want you to look at it. I want you just to understand the concept. We're not here to try to sell you an individual policy, but I want you to understand how these policies work, why they look like a good investment, why they're tax efficient. And what we did in this case for this 35-year-old $1 million policy is we said we're going to do 20 years of funding and we're going to put the maximum amount in that we can for the next 20 years. And you can see it, if you look really small, it's a little over $43,000 a year. The policy itself is something called an indexed universal life. You heard me talk about it with E.F. Hutton. These policies are still around. Instead of a T-bill index, they typically look at an index based on the S&P 500. And we all know what the S&P 500 is. And they assume a yield based on looking back at the S&P 500 within their formula for the last 25 years. The NAIC, National Association of Insurance Commissioners, really regulate us, make sure that we're not throwing crazy numbers out. So this is a 25-year look back on the S&P 500. We also, to get the most money we can in there, start out with something called an option 2 death benefit. It opens up the corridors a little bit more. It also makes it so that you not only get, in this case, the $1 million if you were to die, you get $1 million plus the full accumulation value in that year. So we have an increasing death benefit. You can see in 20 years, it's about $2.6 million. This would be up and down. Maybe it's, $500,000, but up and down, this is how we tend to fund these. After a period of time, we stop paying premiums. In this case, as Justine already forwarded, we stop paying premiums in year 20. The policy has millions of dollars in it. We have shown big gains on the outlays. At that point, we really want to minimize the death benefit. I want to make this look as much like an investment product, just something you would put in your portfolio as possible. So we go back to what's called an option 1. We freeze the death benefit. And then I want to talk to you just a little bit about how efficient this policy is at this point. It's not in the early years because we have a lot of loads that go into the product. You don't have a lot of money. We're carrying $1 million death benefit. But if you looked at years 29 to 30 and you saw the little fonts, the cash value grew from a hypothetical $2.7 million to $2.9 million. This was a 6.21% tax-deferred growth on an assumed crediting rate of 6.3. The point of this is we're talking about efficiencies. Where else are you getting on a projected 6.3% return, 6.2 after all the loads? Nowhere.
Yeah.
Nothing out there
So,
will compete with this.
yeah, this policy looks beautiful. And then the whole point is I really want you not to think I'm buying $1 million insurance, I'm spending $43,000. If you think this way, you should go back to that term sheet. $1 million, you only have to pay $700, right? So why? That's very different. So this is more like you're putting $1 million life insurance as a tax shelter, and then put your investment in there. So the more money you can put into this is better for you.
Right.
That's the whole point of it. That's a very big paradigm change for a lot of my clients, that you're not looking at it as a consumption, as an investment. And this, like Bruce said, should be part of your asset, your portfolio. You definitely should have stocks and bonds and real estate. If anyone tell you the only thing you need is this, and this will do everything for you, walk away from that person, okay? Yeah. You need a diversification. This is what, 10% of your portfolio, 5% of your portfolio. It's your risk tolerance, right? But the point is you got to understand this product. So hopefully when you go get this product, you will be well equipped with all your knowledge. So this is amazing for a 35-year-old that he can do that. And you guys can also see Bruce made a good point. It's a very long-term commitment. That's why it's almost like it's a marriage. It's a long-term commitment you got to walk into, okay?
Yeah, we typically say at least 20 years. We can get away with 15 years before we start taking income up, but I like seeing 20 years plus on this, and which doesn't mean that if you're 50, you're too late to do this. You just don't take the income out until you're 70.
Or maybe you just don't take it.
Or you don't take it out.
Really for you to accumulate there for your children.
Up to you at your discretion at this time going forward. Also, I want to point out that this is a fixed product. You're not in the market. These are indexes. The company guarantees no worse than 0 in any year on the growth. You can't lose principal based on the market returns.
Yeah, it's not, your money is not in the market, it's mirroring the market, right?
No, the company's buying bonds and some options to get to synthesize.
Okay, let's move on to the next one. I think it's more exciting. So the next one is going to be the second phase of this product. We're talking about how do we design and how do we take money out without paying tax. I think Bruce has the same illustration, but here this person, the 35-year-old, start to take money out for his retirement, tax deferred, and in this illustration is tax free. Go ahead, Bruce.
And all we did was we turned on the income stream, and I take what's called zero net loans. The companies, they all do it, will charge you typically 2% to borrow money on a preferred basis or a zero net loan, but they credit you 2% right back. Maybe they'll charge you 1/4 point, and that's sort of safety against the IRS changing their regs. But basically, these loans are coming out, and you could think of them almost like a withdrawal. They're the same dollar in, same dollar out. The income that we get out of it is tax deferred or tax free, as Justine likes to put it. So you're getting, in this case, $229,000 starting at age 66. I took income all the way through age 86, and we'll get to that on the next screen. But you also want to see that every time you pull out that $229,000, the death benefit drops by $229,000. Over the projected period, we put in $832,000 into this policy. We pulled out $4.8 million.
Yeah, it's just simple math, right? Yeah. So I want to point out one thing here, why these distributions are not taxable, just because Bruce said it's a loan. Whenever it's a loan, you're not really like withdrawing the money. You're not taking it, you just borrow from yourself at zero cost.
Right.
That's
if you took this out as a withdrawal, and the moment you exceeded $832,000, it becomes ordinary income.
Yeah. So I can tell you a bad case here. So I said you have to design it well to be tax-free, right? A couple of years back, I did have a 90-year-old client that got a huge tax bill from the IRS, over a few $100,000, because his policy lapsed. Lapsed means he took so much money out of this policy that his policy is no longer there. Remember, it's a permanent life insurance. If the policy lapses, what happens? The IRS is going to calculate how much you put in, how much you've taken out as a loan. Now it's no longer a loan. That's called a withdrawal now, right? and the difference is your taxable income, and it's charged at not capital gain tax rate, but ordinary income tax rate.
Right.
So it's very important. Most of the companies we use have a, what is it called, a protection clause?
It's the other bullet. See that little LG out there? That's no lapse guarantee.
Thank you.
What it does is if we pull too much money out,
stop you taking money.
Yeah, I pulled out as much money as we reasonably can. You could take a look where you could see the cash surrender value over at the right goes to zero.
Mm-hmm.
And normally if the cash surrender goes to zero, a policy will lapse. Modern generation UL contracts have this lapse prevention rider that keeps a small portion of the life insurance in force. If you overloan, you typically need to make it to age 70, and there's some other triggers, but clearly by age 87, we can trigger that. There are no taxes, even though we've pulled out $4.8 million and there's no tax in there.
Yeah. So to me, it's almost like I was having a conversation with a client. He thinks 1031 exchange is so complicated. People make so many mistakes. I'm gonna mess it up. But seriously, if you know what's 1031, you know all the steps, then you will successfully complete one after another to protect yourself from capital gain tax. This life insurance policy, the same. If you design it correctly with professionals, and also when you take money out, you understand what you're doing. This is that is why this great tax strategy. I think you guys can see now why I'm so excited with this whole concept. You can put in money early on, have it grow tax-free, and later on take it out tax-free if you do it correctly. I know Bruce is shaking his head. It's tax-deferred. I know tax-deferred on the tax code, but if you do it correctly, it is tax-free. And I can tell you one thing, I'm a small business owner. This is really good. In my most difficult time, back in 2018, I borrowed a few $100,000 from my own life insurance policy to do payroll. I did that. But I was able to pay back right away, like in 4 months, I was able to. And it's zero interest. Who will at that time loan me that money? Is any bank is gonna loan me the money? I don't think so. And it is great that you have that reservoir there. There are a lot of talks, especially on YouTube, right, Bruce? People said making your own bank, just put the money in and take it out. Both Bruce and I don't like that concept that much. That's called you pushing an idea way too far. Just like someone else tell you, you can invest everything in life insurance. That's all you have to do. Those are all, I think, is a little bit too extreme. So like Bruce said, you have to put in the money for 20 years. So you have to let it grow for another 10, 20 years or whatever. Then you take the money out systematically. But meanwhile, if you were like me, you need some emergency cash. You can always touch it and put it back. So your life insurance policy is intact. Right. Right.
Without picking on infinite banking or be your own banker too much.
We don't like those ideas. This is like, it's a really good thing, but I feel like a lot of people are trying to push their own agenda on it to really make it into a different shape. So we just really today want to kind of get the myths out. Like we really understand what is a well-designed permanent life insurance to achieve your, maximum tax efficiency.
Yeah, but before you go to that, there's another term that I want to throw out there. And, we have preferred loans that we're taking, or the zero net, but there's also indexed loans that float around out there where they index the loan. Instead of being zero, they're going to say, I'm going to charge you 4%. I'm just using an example. The money still stays in the market, and hopefully you're going to get 6%. Well, what happens when the market gets 2%? The loan costs you money. Yeah. None of the illustrations, when we talk to your clients, we show zero net loans. We don't show the index loans. Index loans, if I ran that same 35-year-old, we'd probably be seeing over 300,000, well over 300,000 of income.
So very important thing, every time you read an illustration, know what all the assumptions. It's really important because numbers can be manipulated, right? So the reason we always show the worst possibilities because we like to what? Under promise and over deliver. Right. Nobody's gonna come to me 20 years later and say, hey Justin, you said I can take out 200,000. Now I can take out 300,000. How bad?
Yeah. An 80-year-old, 75-year-old, 80-year-old shouldn't have what we call high beta, high risk in this part of the portfolio. Insurance is safe.
Yeah, yeah.
And especially
My clients who are older than 35, don't think then you cannot do this, because there are different, the design also is very versatile, very versatile. So it's really important for the advisor to know what you're trying to achieve, and does not mean only 35-year-old can buy this policy. But there is one thing I want to really present here, is why we call permanent life insurance an unlimited Roth IRA. They used to call it the big boys Roth IRA. I didn't like it. I will call it unlimited Roth IRA. So if you guys can look at it, first contribution is unlimited, no income limit, and also withdrawal does not need to wait until 59 and a half. You can take it out anytime, but making sure that you have money in there, it's already have enough of accumulation. Don't just go touch that right away. It's like you are planting a tree. You're not gonna expect to see shade in 1 year, right?
Mm-hmm.
That's the point. Okay, I think we're a little bit tight on the time. We have a couple of other things we want. Do you have anything to chime in here, Bruce?
Yeah, when I train agents, and I do a lot of agent training, this is what I compare these IUL products to. I literally compare them to Roth IRAs. I think the Roth IRAs are the best comparison. You should have money in a Roth IRA, but for those that have maxed out the Roth IRA or want to diversify, that's when we start doing this.
Yeah, we have a lot of good clients that have good problems. They would maximize all their 401k stuff, but their income is too high to do Roth IRA. And because they have pre-tax traditional IRA laying around, the problem is, they cannot do backdoor Roth IRA. So this would be a really good option for you guys.
Yep.
Okay. All right. The next thing I want to talk a little bit, it's maybe a little off topic, is because I do a lot of retirement planning with my clients, and we always agree on this. There's three things when you're facing retirement. Actually, one of my best friends visited me last week at the Michigan. We spent a whole week there. She just retired. And this is the three things she's worried. Tax rate go up, right? Inflation go up, and get sick. Those are the things. So we just covered the life insurance, permanent life insurance design can really avoid all the tax in there. And also Bruce talked about the index universal life will have some kind of a growth mirroring the index. So that would be a good hedge against the inflation, right, Bruce?
Yeah, we're going to get most of the market. That's the whole point about these industries.
We have that because everyone knows when the interest rate go up, the index probably go up too. It's kind of like going together, going up and down. Mm-hmm. So the last thing we're going to touch is how about if you get sick, right? We have Medicare, but Medicare does not cover long-term care. So we can actually show you something that Bruce talked about now. We can incorporate even long-term care into this permanent life insurance design. Go ahead, Bruce.
Okay. So I get on a little soapbox these days about the importance of long-term care. I've had personal family that's needed it. I have clients that need it. The government is not going to take care of you. You're going to have to burn down your personal assets first. So the life insurance industry has tried to aggressively help out there. We have traditional long-term care riders that are tax qualified under the code that we can add to many life insurance policies. It's permanent insurance only. And in this case, with this particular company, and we'll talk about companies later, but we can take that full $1 million face amount that we initially bought and get $20,000 a month if you qualify under the standing regulations, again, highly regulated, where you satisfy 2 out of 6 definitions of daily living or activities of daily living, and like toileting, bathing, continence, eating, transport, cognitive. So if you fail 2 out of 6, or you just have cognitive, you can trigger the rider and you can get $20,000 a month out of it until you exhaust the full $1 million. This is a great benefit built into a policy already. And it's a very low cost benefit. And if you go to the next screen.
Let me do that for you.
Okay.
It's
you
the
see,
same
there's the income
right?
again.
Yeah.
And the cost of the rider for the life of the policy reduced the projected income by $2,000. this is almost a no-cost rider. And I would highly encourage everybody to take advantage of this rider. Because what happens, my own sister had an event when she was age 50. We don't think anything's going to happen to us when we're 50. She ended up going through millions of dollars of long-term expenses that would have been covered by long-term care.
Yeah,
Really
so
changed the
from
family.
our culture, we're supposed to take care of our parents. My children are supposed to take care of me. But my biggest worry when I turned 50, I also purchased a long-term care policy linked with a life insurance like this. But it's a very different design because I was too old for the accumulation. Actually, Bruce helped me design that. I bought a joint policy with my husband. And see, my biggest worry when I was 27 with two little kids is how about if something happened to me? So I got term, right? But when I turned 50, my biggest concern was not if I leave. I'm very proud to see my children are very independent and I did my job. But I would not want one of them to stop pursuing what they love to do and come take care of me.
Right.
And I also don't want to spend all the money I have to take care of myself. I still want to leave something for them, right? So that is why we bought a policy at that time. But because I was older, it was much more expensive. But to me, it's still better than not having it. So long-term care is a real concern, and it's a real need. Like my good friend last week, she retired, 67 years old. She has about $2 million in retirement, and she said, "Do I have enough?" I said, "You have enough, but would you like to leave some for your children?" And we touched upon long-term care right away. This is, and at her age, it will be hard to get a policy, right, Bruce? 67 is hard.
It's the client I'm thinking of.
Yeah.
Underwriting becomes progressively more difficult. It's not mortality driven like life insurance. It's morbidity driven.
Yes.
Instead. And as we get older, little things creep up on us and we get closer to a chronic illness event, and underwriting becomes much more difficult. Placement ratios.
And in this 35-year-old, if we just add that little rider in there, all it affects is when he is 80 years old, $2,000 a year on the tax-free income. It's really nothing, right? Yeah. So we should combine that into it. Yeah. So now this policy addresses all your issues. I'm sorry, we're running out of time. So this, I also want to touch upon. Some of us are fortunate, not me yet, enough to hit estate tax limit, right? So let's first take a look at the federal estate tax exemption. From 2018 to now, it was the golden age for, I guess, for us to die. It's a really morbid thing to say, but your exemption is so high due to the Trump tax reform. But it's gonna revert back in 2026 to what, 6 million, right?
5 million.
Maybe even 5 million. I know, maybe even
the code's written right now at 5 million.
It's 5 million. Yeah. So it's really gonna come down. Okay. So, and if you are, let's say today, 40 years old, you have 2 million, you think, I'm never gonna hit it. If you're 40, you have 2 million, you very likely will hit it, because guess what? When you make your first million, it's really hard, but the money will make money. And especially if you're really diligent about avoiding tax, then you will hit that estate tax. So what do we do when that happens? Most common thing we want to talk about is an irrevocable trust life insurance, right? So first, what's an irrevocable trust? So you basically put away money like in the trust. Irrevocable means you cannot change it. So technically you don't have that money anymore. So the growth in that trust will no longer be within your estate. Mm-hmm. Give you an example. I have a $2 million property today, right? And I am 50 years old. By the time I die, I'm 80. This property will be worth 10 million. If I put this $2 million property in an irrevocable trust, when I die, that 10 million is not going to be included in my estate. But the 2 million will be counted towards my lifetime exemption. Mm-hmm. I hope sometimes it's just a lot of words, but it's very different than a will and a living trust. living trust is really help you to avoid probate court, right? Irrevocable trust is really for you to avoid or mitigate the estate tax. While you have a life insurance put into the irrevocable trust will provide you so much liquidity to pay the death tax if you have to. And I guess Bruce can talk about the design a little bit. We call the ILITs, right?
We like to abbreviate everything. So irrevocable life insurance trust is ILIT.
ILIT.
So,
okay.
We have for decades. We've had our wealthier clients that anticipate estate taxes purchase either individual policies, permanent insurance, or survivorship policies where a husband and wife will buy a joint policy that pays off at the second death. Because when you do your trust work, you'll have an AB trust in there too that will say when we want to pay the taxes, there's no tax due upon the first death. And so why not buy a survivorship product? The reason to buy a survivorship product, they typically are 20 to 35% less than buying a policy on one or the other of the two spouses. So we get a lower outlay for those policies. Those policies, we don't tend to max fund the way we do, as you mentioned, LIRP, life insurance.
Yes, as we design as a tax.
We design it purely for death benefit protection because you're never gaining access to that cash. It's in an ILIT. It's not your money anymore. It's only there to provide the life insurance product. And when Justine talked about putting assets in a trust, if you put property in a trust, you have to pay taxes at trust tax brackets. And they're very high.
Yeah, on the rental income. If you receive rental income from that property, the trust will have to file a tax return every year and pay tax. And the income tax bracket is very high for a trust. But the whole point is to avoid estate tax here. Right. Because
you also avoid tax if you use life insurance as that funding vehicle.
You avoid both. You avoid the income tax and the estate tax. Yeah. One thing people sometimes don't get it is estate tax rate is higher than the highest marginal income tax.
Yeah, it can be very high.
Yes.
Especially in certain states, like California, because there's federal estate taxes and state estate taxes, and sometimes they cooperate, sometimes they don't. And you could easily be looking at 40% to 50% estate taxes, depending on what state you reside in.
Oh, easily over 50. I mean, when you combine the federal and the state, it's easily over 50. Yeah.
Yeah, it can be. It can easily be. And we have no idea where it's going in the future, but the sunset of the current estate tax regs is written down. It's December 31st, 2025, January 1st, 2026. If you die, instead of enjoying the 13 million and change ahead deferral that we have now, it's going down to 5 million.
Yeah, so you need to really do something before the end of next year. I actually had a lunch with an estate attorney yesterday, and I said, have you guys been busy since 2018? We're going to be busy next year. The thing is, people wait until, he said, we'll be so busy that we're going to be, the whole year is going to be tax season.
Yeah, there's an issue with that, and everybody listening that may be in that situation. I deal with a lot of estate planning attorneys. I deal with a lot of high-end clients. And all the attorneys are saying, do your planning now because I won't have time to take on any new clients after like May or so of next year. Yeah. And they're dead serious about it because they have so much revision work on existing clients.
And a lot of them are waiting for she said a lot of them are waiting for the election. Maybe it will become a permanent change and it would be 12 million for the rest of the years.
And there's a lot of I don't want to go political, but there's a lot of discussion on what will happen. But every attorney I'm talking to says we have to operate on the code.
I want to give a really simple. I think we did this kind of illustration for one of my clients. I don't know whether he's here. I'm not going to talk about your name, right? So basically, we're going to put in about $1 million into this policy that will grow to 10 million when something happened to both, to the last to die policy, right? So their kids can use that 10 million to pay any estate tax that they will have to incur. So from the 1 million to 10 million, they don't have to pay income tax. And that 10 million is not in their estate, will not be part of their estate. So it's a really good design for you to provide liquidity for your estate, and then also avoid, like, it's a much better way than you put property into the irrevocable trust. Some people got to do a couple of them, maybe many of the irrevocable trust, right? That's maybe, again, it's a different topic. But in the life insurance topic, this is also a really big tax efficiency play.
Yeah, we've been, as I mentioned, I've been doing this for 40 years. I've been doing estate planning that full 40 years. I was a CFP and have an MBA. All my clients are fairly high end like you, and they understand the leverage that life insurance offers here and the advantages, because the IRS is going to get their money. There's very few of us are lucky enough to have that problem. But if you do have that problem, there are solutions. I think we're really running out of time, Bruce, and I two old people talking jab. Okay. So you can, I think there is a link that my assistant's supposed to send to all of you guys to schedule a call with me. If you are interested in knowing more the design, or if you want Bruce and I design some plan for you and your family, go ahead and schedule that. These are to follow us, and let's go to questions. So is Christy or Kiki gonna pop up the questions, or do I need to go in there?
Well, we actually so far just got 2 questions.
Oh, that's fine. There's only one question. Peter, how are you?
So the other one, I don't know why I cannot see it, but you can.
No, that's okay. Peter, 16-year-old is not too old, but also not too young, right, Bruce? How you?
I'm sorry, what?
No, Peter is asking, is 60-year-old too old for the LTC policy?
No, absolutely not. No, and it's a good.
And Peter, I think I probably did a design for you 2 or 3 years ago when we first met. We can revisit that. It's okay. I guess there's no questions. We did such a good job.
We have another question. I converted to Q&A. I don't know why I cannot find it now. The other question is, are we talking about UL, not whole life here, right?
I think it's okay if we can't even find the question. Don't worry about it, Christy. I think me and Bruce just did such a good job. Nobody has questions.
But I feel that question is a good question, whether you guys want to elaborate a little bit more on that.
30 seconds on UL versus whole life. We can do it with both. They operate under the same tax code. There are pros and cons to a traditional whole life. We represent many whole life carriers, particularly New York Life and Mass Mutual. It's a different system. They are not as flexible as Universal Life. You're talking about dividends versus being invested in an index or some other market instrument. There's no right answer, but we happy to look at both. I think
we try to steer away from what's the best kind of products for you, because everyone's different. Really trying to focus on the tax strategy, tax perspective on how you can design a perfect life insurance policy for you and your family. All the products, companies, different designs, they're very complicated. It's really, really very complicated. It's not something just a cookie cutter.
Right. Mm-hmm. But again, happy to look at whole life. And
so if you have questions, schedule time with me. This is a very individual thing. You cannot, be cookie cutting, giving you a vanilla one strategy.
Here's Byron.
Hey, Byron, how are you?
Byron, you and
I'm very honored you're attending.
Yeah, it's 2 a.m. your time? Oh my gosh.
I think he's back to California.
Is he back? Okay. Byron, if you reside out, you and I need to talk. There are some limitations of what can be used outside of the country. We do have companies that do support it, but we have to take those limitations into consideration. I do have options.
Byron, you can call me anytime.
Yeah, you know how to get a hold of me too. But if that's Is that all we have? That's all we have. We're coming up on the hour.
It's good. Yeah, I really, if I don't know whether we're going to do a survey. If this is interesting to my people, we can also have follow-up webinars on like what kind of design is suitable for what kind of people, what you're looking for. Not exactly to the T, but we will have a couple of typical profiles we can talk about if the response to this is, people still want to hear more about it. Yeah. Thank you all. Thank you for your time, and thank you for for being my loyal clients. And we have enjoy the summer. That's it.
Okay.
Thank you, Bruce.
You're welcome. Bye-bye.
Bye-bye.